You've gotten the big news of the day, the decision from the Fed to buy $45 billion in Treasuries starting next month to keep its gas pedal pushed down, its monetary gas pedal pushed down because of concerns about the labor market. Going to continue also to buy $40 billion in mortgage-backed securities. And as you said, it's going to adopt these numerical thresholds for inflation and unemployment as it decides on Fed policy going forward. But let me walk you through the projections that made the basis of that decision in that statement that we saw earlier today. The Fed slightly revising its forecast for economic growth next year, and going to focus here mainly on 2013, 2014. The central tendency of Fed policymakers for growth, 2.3 to 3% for 2013. The unemployment rate's been knocked down to 7.4 to 7.7% for 2013. PCE inflation, 1.3 to 2%, again slightly lower than what we saw back in September from the Fed. And core PCE also down to a central tendency of 1.6 to 1.9% for 2013. 2014, 3.0 to 3.5% GDP growth. That's a little bit down again on the front end. Unemployment, 6.8 to 7.3% for 2014, according to the Fed's central tendency. PCE inflation, 1.5 to 2%. Of course, people will be keeping an eye on that, given the new threshold. Core PCE, 1.6 to 2%. So when will the Fed start to tighten? Again, according to the Fed projections, 13 of the 19 Fed officials surveyed now say it will happen in 2015. In September, that number was 12. 5 think it will happen before then, 1 in 2016. And where will the rate be at the end of 2015? 10 think it will be at 1% or higher. It was 13 in September. 5 think it will be at 2% or higher by the end of 2015. So again, Mark, these are the individual projections of Fed policymakers, those at the table today. We don't know who those individuals are in terms of the projections. No specific identification, but of course we're going to get some more detail from Fed Chairman Ben Bernanke coming up at the news conference.